over a cliff. Now, Marx had a more subtle way of explaining it than I just outlined, and in particular he sees the most important cause of crisis being the interaction of these two fundamental features that I talked about, the exploitation of wage labour and competition. And in particular he said that what competition does is encourage capitalists to invest to a greater extent, to invest in larger quantities of machinery and so on and so forth that would help to make the workers more efficient, more productive, and thus cut their costs relative to their rivals. So that there's a tendency in the development of capitalism for investment to grow on a massive scale. The problem that then creates is that the source of the profits comes from the labour of the workers. And so if you have a situation in which this blind process of competition is leading to greater and greater investment into machinery, computers, all sorts of things like that, the raw materials that are processed to produce things, then the workers, who are the source of profits, become dwarfed by these investments. And that means that the profitability of capitalism as a system declines. In other words, capitalists, in order to be successful, don't just need to make profits, they need to make profits that represent a good return on their investments. They plough all this money into buying machinery and employing workers, and they've got to make a return on their whole investment. But if their investment is growing more rapidly than the workers who are providing them with profits, their rate of profit is falling. And it's this, what Marx called the tendency of the rate of profit to fall, that produces economic crises. Now that may seem like a bunch of abstract hoo-ha, but in fact, if we want to understand the present economic crisis, we have to see it as originating in a crisis of profitability that developed in the late 1990s. In the late 1990s, the American economy, which remains the core of the system, experienced a significant fall in its rate of profit. And the people who manage the American economy, and these days, or certainly for a long time, it's been the Federal Reserve Board, the American Central Bank, were worried about a serious economic slowdown. So what they essentially said was, we'll make it as easy as possible to borrow money, and we'll hope by flooding the economy, not just the American economy, but because of the integration of global capitalism, the world economy, by flooding the economy with cheap credit, that will encourage people both to spend, but also to speculate with different things, and most recently it was to speculate with housing, and that will, if that works well, the speculation will push up the price of housing, property prices will rise, the familiar London story that we're so aware of, and people, because they, the value of their houses, the monetary value of their houses will rise, will feel richer, and they'll spend more, and they'll probably borrow more because they can afford to borrow more because the value of their houses are going up. This may sound completely mad, and it was, in not a very long term, proven to be completely mad, but this is genuinely what the people who ran the system tried to do. And for a period they were successful. I mean, in 2003, Alan Greenspan, who used to be the head of the American Central Bank, cut interest rates to 1%, which made borrowing really cheap. And the result of that was a huge increase in the price of housing in the United States. And that did feed through to spending. People spent more, and that helped to keep the American economy going, and through keeping the American economy going, that also helped to keep the world economy going. Incidentally, one reason why they did it this way was because at the same time they were pushing down on people's wages. So if you look at most of the major economies in the last few years, people's wages, take into account inflation, have fallen. So if you're squeezing people's income, how do you get them to spend and therefore to keep the economy going? Well, you have to find some way of making them feel rich and encouraging them to borrow, and therefore getting the price of their houses to rise was a way of doing that. As I say, This may seem completely mad, but it is what they tried to do. Now, and that produced an increasingly a boom that was driven by this kind of financial speculation. Now, the problem with these booms is, as I said, capitalism is a system driven by competition. And the more the boom goes on, the harder it becomes to make an easy profit out of the whole thing, because the easy profits of profitable things have already been seized by other people. So you go in for more and more dodgy deals, and that's what then precipitated the collapse of this huge speculative bubble in housing, the so-called subprime mortgages, bit of the American mortgage market. In other words, what you had was all sorts of crooked firms who lent money to, who gave mortgages to really poor people who couldn't afford to buy their own homes on terms that looked, on paper, really good, but over time required those poor people to spend more and more of their very limited income on paying back the crooks who had lent them the money in the first place. And that, as you know, that was bound to blow up, and it did blow up. And once it blew up, it then led to an unravelling of the whole financial system, because as the boom developed, more and more the global financial system, not just the American banks, British banks, continental European banks, got involved in different ways in these kinds of speculative loans. And then what happened, once the bubble burst, as it did in August last year, then increasingly these banks were confronted by the fact that they were stuck with massive quantities of bad loans, of loans that they weren't ever going to be repaid off. And as time went on, it became clear that the problem was bigger and bigger. I mean, this firm, the insurance company that I referred to, AIG, no one had thought that AIG, which is an insurance company, would be involved in massive amounts of speculation, but it was, and in the end it pulled it down. And the result was, over months and now years, paralysis as banks stopped lending to each other. They stopped lending to each other because they didn't trust each other, because they didn't know how badly off, how much bad loans everyone else had. And since the loans between banks and to firms that want to invest are critical to fueling the capitalist system, the central mechanism, the nervous system of the capitalist economic system has essentially frozen up. And when you add to that the bankruptcy of a number of major firms, that then produces the kind of panic that we've seen in the last few days. And you know, as really, really big firms go bust, then there's a threat to the collapse of the whole system. And it's in those circumstances that the state steps in. And the American state, as I've already said, has done incredible things. A couple of weeks ago, they nationalised these two bizarrely named mortgage companies called Fannie Mae and Freddie Mac, which are responsible for 3/4 of all new mortgages issued in the United States. That increased American government debt by the equivalent of 2/5 of the American economy. As a result of that, the financial markets are now including in their calculations the possibility of the American government going bust, not being able to repay its loan. This is unbelievable. You know, the US is supposed to be the kind of sound core of the financial system, the kind of stamp of the guarantee of security and value for the whole system. But the scale of the rescues that they're engaging in threatens the credibility, the credit, in literal terms, of the American state. Now,